In terms of the approach to planning an audit engagement, we have basically 8 points or steps, right? The first is you accept the client, right? Once you accept the client, you perform your initial audit planning of the engagement, and that includes understanding what the client's business, understanding their business, understanding the industry. And when we work on the Toy Central case a little later in the class, you'll see the connection, right? So you have to understand, well, what kind of business is this client in? What's the industry like? Most firms, I think all of them really, most of their audit people specialize. They're going to be, they might have 1 or 2 industries that they work in, some of them 3, but for the most part, they're going to specialize in a particular industry. Why do you think that's important? Why would the auditor firm want their people to specialize? Right. So when you specialize, you have a better understanding of that industry. So you're going to be more, you're almost becoming like an expert, right? So you develop expertise about, so you're more knowledgeable about the accounting transactions. You're more knowledgeable about the economic factors that impact that industry. You're knowledgeable about what's going on in that industry. And then you're able, when you're looking, for example, if you're performing analytical procedures, you're kind of comparing your client's performance against industry benchmarks, you have a better sense of whether or not the auditor, your client, your audit client, is falling outside of that industry. Does something not make sense? If the industry has experienced a significant downturn and your client is showing revenue through the roof, that might give you pause. Like, what is it that's caused, why is it that they're way up here and the industry is going in the opposite direction, right? You'd have to know that, right? Another thing is you assess what the client's business risk is. And that's you talking to management, again, knowing what the industry is, knowing what kinds of products the client has, where they are in their product cycle. So for instance, let's say you are a pharmaceutical company, you're auditing a pharmaceutical company. One of the things you're going to want to understand is, well, what kind of products do they have out there? Are there any products that they have that they patent, right? So that they really, because when you patent a product, you're out ahead of that industry, and you're probably, generating a lot of revenue from your patent products. You'd also want to know if you're let's say you're auditing a technology company, where's your client's products in relation to the industry? Are they kind of falling behind? That there are new blockbuster products that are coming out that's going to put your client's product, make it obsolete, right? What do they have in the research and development pipeline? Why are those things important, do you think? Yes, Vivian. Right, so you want to know where are they, right? In the sense that if they're not developing products, especially if you're in technology, right? In the technology industry, you're going to quickly start losing revenue, right? You're going to start losing market share, right? Because if you're not aggressive, and then so the auditor wants, because that leads to what? If you're losing revenue or market share, there could be liquidity issues, right? That brings into the play, are there some going concern issues, right? So, but the auditor wants to know that. Then you also want to know that what if it creates pressure on management? A lot of times management's compensation contracts might be tied to their performance, how the company is performing in terms of market share, in terms of the share price or revenue growth, right? And so if your client is losing market share, you're going to look at, okay, that might increase inherent risk in the sense that are they more willing, or is there great incentive for them to manage earnings? Right? So those are the kinds of things you're looking at those. Performing preliminary analytical procedures. And what analytical procedures are, it's a host of things. Analytical procedures consist of ratio analysis. It consists of comparing year 1 to year 2 to year 3, looking at how your audit client compares to the industry, how they're performing, looking at relationships between accounts. So for example, let's say the company is experiencing a decline in revenue, right? And accounts receivable, however, is increasing. There's a relationship there. What's that relationship? Does that make sense? What do you think? Sales revenue is going down, but accounts receivable is going up. Omar.
Prior to last year's sale, they probably receiving now for this year.
So let me think about this. So sales are going down, accounts receivable is going up. So you think that if accounts receivable is going up, then that would mean that they're not collecting, right?
Yep.
Right. So they're not collecting, and what does that mean when they're not collecting? What's your risk here? I'm sorry? Right, your allowance for doubtful accounts. So your concern as an auditor, the thing that's going to click for you when you see that, understanding that relationship, right? Sales are going down. So if sales are going down, I would expect to see a decline in accounts receivable. If I don't see a decrease in accounts receivable, that raises a red flag, right? Because if sales are going down, that means you're not making sales. So why should your accounts receivable increase? The only reason why your accounts receivable is going to increase, or possibly, is you're not collecting on what you did sell, right? And if you're not collecting, then I'm going to look at your allowance for doubtful accounts and try to determine, well, is this allowance for doubtful accounts even reasonable, right? So you want to look at those relationships. You want to look at the relationship between, things like inventory and inventory obsolescence, right? So if we see that inventory is increasing, but we're not buying any, cost of goods sold, we're not buying any new inventory, but we see that number is going up, that doesn't make sense. What does that tell you? Right, that inventory, there may be, we're looking at obsolete inventory. We're not moving our inventory, we're not selling. And so that means that, okay, now I have to look at whether or not there's increased obsolescence. So it's important to understand the relationship. Right? Also looking at industry trends. What is going on in the industry? As I pointed out before, what if your client's sales are going gangbusters and the industry is going in the opposite direction? What does that mean? What could be a possibility? Your client is moving up, the industry is going down. What could be a possibility? What would you look for to explain that? Your clients, their sales revenue is going up, however, you're seeing that the industry, on average, revenue is declining. Yes.
Maybe they have like an advantage, like a competitive advantage to maybe their industry, but maybe they're leading the way, even though maybe they have like a patented technology.
There you go, right? You would say, okay, well, do they have patented technology? Did they come out with some blockbuster product that's making them rise? Is that easy enough to check? You would know that, right? Because you're understanding your client business. You know what products they have. You know what research and development they've been doing and whether or not that research and development has paid off. Did they just patent some new project? So then that's the relationship. Okay, then that makes sense. The reason that they're going gangbusters and the industry is declining is because they're far ahead on technological development. And you would know that. You would look for that relationship. If they didn't have that, right, if you said, wait a minute, this doesn't make sense. Why is their revenue going up and everyone else is going down? That's going to raise a red flag. You're going to look at sales revenue a lot closer. Right? Because one of the ways, and the researchers pointed this out, and if you look at just the anecdotal evidence, that companies manage earnings is revenue is the biggest way. Right? That's their first, they're going to first look at how can they manage the revenue process to manage earnings. So performing analytical procedures. And the important thing And I want to point out about analytical procedures. All of these other things that you're doing here, doing your initial audit planning, understanding the client's business as well as the industry, assessing what the client business risk is. The reason you're doing those things is they help you form a basis, an understanding. Because analytical procedures are useless if you do not have a good foundation going in to base your expectations on. Right? Because what analytical procedures are doing is saying, hey, I have some expectations about how something should work. I have some expectations about the relationship between sales and accounts receivable, right? Or between inventory and inventory obsolescence, between my audit client and the industry. I have expectations. And the only thing you can do is assess, take that information and apply it against your expectations and see, does it make sense? If we're conducting a ratio analysis, that's a simple mathematical calculation, right? If I'm looking at current assets, current liabilities, right? I'm looking at the current ratio. Simple, I perform that simple calculation. What does that tell me on its face? You guys have done ratio analysis? So what does it tell me when I look at my current ratio? So I perform, because we can all divide. Current assets divided by current liabilities. What does that tell me? When I get that number, what does that number tell me by itself? Do I take that to mean it tells me nothing? Fine.
It tells me how, if I'm able to pay off my debt, sort of like my liquidity.
Okay, so it tells you something about liquidity, right? It tells you about the liquidity of the company. Are you generating enough? But is that enough for you to say, oh, this company has no going concern issues? Is that enough? No, right? It's going to be all these other things, right? So it's just saying to you, when you perform ratio analysis, you have expectations. So you're going to say, okay, this is trending in the right way. It doesn't mean I stop here and I do no additional work. I still have to do some additional work. If you had some expectations about, industries going down, they're not generating as many sales as they were. Their accounts receivable is increasing, so they're not collecting. So if that's going on and you see that their ratio says otherwise, those two things don't make sense. So you have an expectation, right? And you're going to evaluate the outcome of those ratios against your expectations. So that's why it's so important to develop, to perform the necessary procedures to make sure you have sound expectations. Yes, Jimmy.
The receivers, possibly stock because of their operations, could be their financial or investment accounts that they were expected by. Some companies are not, even though some companies are more concerned with some more operating.
So I'm thinking about your accounts receivable, trade accounts receivable. So if your trade account, because your trade accounts receivable really is tied not so much to your investing, right, but it's tied to your sales, right? So your revenue. If you're generating revenue, right, and we're on an accrual basis, you're generating revenue, you're going to debit accounts receivable, credit cash. I'm sorry, credit revenue, sales revenue. So once we collect it, so we expect to see that accounts receivable number kind of go down, or in a 30-day period, let's say, we expect to see that they've collected on that. So if your revenue is going down, but your receivables are going up, I think that is more indicative of you not collecting. I'm not sure I see the connection to investments. If you're talking about receivables in general, you could be right. Right, but but the trade receivables, when I talk about accounts receivable, I'm thinking trade receivables, because that's tied to your selling process, right? Your sales process. Did I misunderstand what you were trying to get at?
Close enough.
Okay. All right. Okay, so your analytical procedures, we're going to talk about materiality and audit risk next week. and inherent. So the inherent risk is a component of the audit risk model. And your inherent risk is really determined by these procedures here: understanding the client's business, assessing what their business risk is. And your inherent risk is kind of linked to what's the susceptibility of a misstatement in this account, right? So it's looking at the susceptibility of account to a material misstatement. So we'll talk about that more. But again, this is a part of the planning process. You have to set your materiality. And materiality, as we said much earlier at the beginning of the semester, was what would change the decision process or impact the decision process for a reasonable user of the financial statements. Right? And that's how auditor has to assess it. So we'll talk more about the qualitative aspects of materiality as well as the quantitative aspects of materiality next week. And then this idea of the audit risk model. And what the audit risk model, basically audit risk is, how many people know what audit risk is? Heard the term before. Have you heard the term prior? Right. So the audit risk, right, is the auditor's risk. Right? And it's the risk that they issue an incorrect opinion. Right? And the bigger risk to them is that they issue an unqualified audit opinion when in fact they're material misstatements. Right? Because if they're material misstatements in the financial statements, that would suggest that they issue a qualified or an adverse opinion. So their greatest risk is when they issue a clean, unqualified audit opinion when in fact there are material misstatements. And so what an auditor is going to do with the audit risk model is designed at how does an auditor try to mitigate that or to reduce that risk that they will issue an incorrect audit opinion. So we'll talk more about that next week. And then understanding internal controls and assessing internal control risk, also a component of the audit risk model. And what we'll talk about when we talk about the audit risk model, the auditor can only control audit risk. They have no control over inherent risk, and they have no control over control risk. Right? That is, they only assess that risk based on client information. So based on how well they go through this audit planning process, right, is going to be directly related with how well they assess inherent risk and control risk. I'll go into detail with that more. The other thing that they're doing in the planning stage is gathering information about fraud risk, which is very different from fraud. They're not identifying fraud, they're identifying the risk of fraud. So, and we'll talk about that in a few weeks when we talk about fraud, but they're identifying where, based on these procedures that I perform, based on my assessment of control risk and inherent risk, where is the risk for fraud? Where might fraud be perpetrated in this? So let's say, for example, the company has lax internal controls, right? They don't, they just don't really, they don't have good controls in place, and where they do have controls, they're not following. The auditor would probably determine that that increases the risk of fraud. If there's a lack of segregation of duties, right, then that increases the risk of fraud. So that's what the auditor is doing in terms of assessing fraud risk. They're not saying we're going to find fraud. We're just saying the fact that these things exist increases the risk of fraud. And then based on that, they develop their overall audit plan and their audit program. And their audit plan and their audit program is their audit approach. Right? My plan is my approach. So, for example, if I determine that, this is a solid client, they're really concerned about issuing quality financial statements. So in other words, as an auditor, I'm not concerned about the integrity of the client. I feel that they have high integrity. They set this tone at the top that is very focused on quality, very focused on internal controls. And so the auditor then says in controls, they have an excellent control environment. I can rely on internal controls. So in those two, in that simplified case, control risk is low, inherent risk is low, and because those two things are low, then I can say there's the chance of there being a material misstatement is low. And then my audit approach is to rely on internal controls, so I'm going to test internal controls. And then I'm going to reduce my substantive testing or the detailed testing that I do. Right? Because I can rely on internal controls, I can reduce that. So my audit approach is to rely on internal controls, reduce my substantive testing in order to keep my audit risk low. And that's what I mean by and so the audit program will be developed based on that audit approach. But we'll talk more about it when we talk about the audit risk model.